Hi everyone, welcome to our video. We are from SIQ3004 Group A6. I'm PINGTONG and my groupmates are WENXUAN, Asyraf, IDLAN, HAZWAN, ELISHA and ZHAOYU. In our video, we will analyze a long straddle option trading strategy using NVIDIA Corporation option based on real market data. A long straddle strategy involves buying one call option and one put option with the same strike price and expiration date. For our market outlook, we expect higher volatility in NVIDIA's stock price due to uncertainty and rapid developments in the technology sector. The primary objectives of this strategy are to profit from large stock price movement, to take advantage of high market volatility, and at the same time to limit potential loss to a fixed amount.
My name is AHMAD and I will explain this part. Actually, we are collecting this data for NVIDIA, for investing.com. So why we are choosing this data is because NVIDIA is actively traded in our financial market now. And NVIDIA option it also have a high volatility and it is suitable to study how different contract specification that affect the option values. So 6 month expiration date have been chosen. So why we are choosing that is because we don't want the period have too short or too long. So with the short, we can see the price movement to the time decay, and also if it is too long, they can have a high uncertainty and more expensive. So 6 month is suitable for analyzing the stock price movement and option pricing.
Good day everyone, now I will explain how we build our long straddle strategy. We buy one call option and one put option on NVIDIA. Both options have the same strike price, 230, and the same expiration date, 20 November 2026. The current NVIDIA price is 225.32, so the 230 is close to the current price. And the call option helps us if NVIDIA goes up a lot, and the put option helps us if NVIDIA going down a lot. So we do not need to guess exactly direction. We only need the stock price to move far enough. But if NVIDIA stays near 230 at the expiration date, the strategy will not perform very well. So the main innovation is that the strategy is based on the volatility, no direction. It is more flexible than only buying a call or buying a put. Also, the maximum loss is limited because both options are enough. This makes the strategy suitable for NVIDIA since we expect the high volatility.
The payoff function is the combination of both the call option payoff and the put option payoff. The call option becomes valuable when the stop price increases above the strike price, while the put option becomes valuable when the stop price decreases below the strike price. For the profit function, the net premium paid is deducted from the total payoff. Therefore, the strategy only becomes profitable when the stop price moves significantly in either direction. The payoff diagram forms a V-shaped structure because the strategy profits from large upward or downward price movements. If the stop price rises sharply, the call option generates profits. On the other hand, if the stop price falls significantly, the put option becomes profitable. However, if the stop price remains near the strike price, the strategy experiences maximum loss because both options lose value. Therefore, the strategy is more suitable in highly volatile market conditions.
This slide talks about the result and analysis of our long straddle option strategy for the NVDA stock. We buy both a call and a put option with the same strike price of 230 and has the same expiration date, which is 20th November 2026. The call premium is 31.3 whereas the put premium is 28.95, leading to our maximum possible loss of 60.25, whereas our maximum profit is unlimited. The upper break-even point is 290.25 whereas the lower break-even point is 169.75. This strategy becomes profitable if NVIDIA's stock price rises above 290.25 and falls below 169.75 at expiration. The call option gains value when the stock price increases above 230, whereas the put option gains value when the stock price decreases below 230. This strategy is useful when we expect high market volatility but are unsure whether the stock price will go up or go down.
Alright, now I will talk about the risk and the reward from this strategy. Actually, the long straddle strategy has a limited risk because it has a maximum loss in a certain value, but it potentially have unlimited reward because it has a maximum profit, which is unlimited. And then another risk is the time decay. It will reduce option value as expiration approach. The investor may suffer losses if the stock price remains relatively stable for a long period. And then from this analysis, investor expecting uncertainty may prefer a long straddle because it allows them to profit without accurately forecasting the direction of the movement, even go up or down. And the long straddle strategy is highly dependent on volatility rather than market direction.
Now I will present our recommendation and conclusion. We recommend using the long straddle when investors expect strong volatility in NVIDIA. This strategy allows investors to profit from a large price movement in either direction. From the table, the strike price is 230 and the net debit is 60.25 per share. The strategy becomes profitable if NVIDIA rises above 290.25 or falls below 169.75 at expiration. In conclusion, this strategy fits a high volatility outlook. The main risk is that if NVIDIA stay near 230, the maximum loss will be 60.25 per share. Therefore, this strategy is suitable for investors who expect a large price movement. Thank you.